Dear students, welcome to lecture 3 of week 5, wherein we have been talking about processing and financing export orders. This lecture 3 is all about export financing, the need and sources. Let us begin the journey. We are going to first take a look towards all the contents of today's lecture. We will be talking about the introduction of export financing as well as the concept of export financing initially. After that, we will talk about the importance and strategic role of export financing, followed by the key features and objectives. After that, we will talk about financial challenges in international trade. Not only this, we'll try to identify the stages requiring finance, followed by internal and external sources. After that, we will try to understand the institutional sources, followed by government support schemes. Subsequently, we'll try to understand international financial institutions, followed by comparison of different financing sources. And upon reaching the end, we will talk about the criteria for selecting financing options as well as the future trends and strategic insights. Before concluding our lecture, at the outset, it is imperative to understand that export financing refers to the finance or financial support which is required by the exporters for indulging in the exporting activities. Generally, this finance is used as working capital requirement for the exporting firms, which is required to convert semi-finished goods into finished goods that can further be exported. The need of finance differs at each stage of export financing. Export finance enables smooth order execution, production, shipments, documentations, and payment realization. Export financing is essential due to long trade cycles, deferred payment, and high capital requirements. Export financing plays a vital role in promoting international trade and enhancing exporter competitiveness. Let us now try to talk about the concept and definition. Export finance is very important concept in promotion of exports and trade facilitation. It is a financial assistance extended to exporters to facilitate production, shipment, and sale of goods and services abroad. This particular export finance covers the period from order received to realization of payment from foreign buyers. This can be short term, medium term, or long term depending on the nature of transaction. Generally, the classification is not very strict compartmentalized, but still the short term requirement is the requirement which is used for a particular working capital cycle, that is short term. Medium term is between 1 to 5 years, and long term is more than 5 years. So these criteria are generally followed, but the strict compartmentation is not possible. Neither there is some kind of strict definition for short term, medium term, and long term, because these time zones may differ from type of industry. Certain industries may require more time than others, and so on. Export finance is generally provided by banks, financial institutions, government agencies, and international organizations as well. Let us now try to identify the importance of export financing. Export financing bridges the cash flow gap between production and payment realization. We can call it that export financing actually supports or provides supports to the lacunas into the cash to cash cycle. Let us understand what is cash to cash cycle in international trade, that is in exports. The cash to cash cycle is the time taken for conversion of the product into cash. For example, when we purchase raw materials or whatever inputs we are purchasing for production, we pay cash and we keep on paying expenses and other raw material costs in terms of that. But once this particular thing is gone into the production processes, it is not realized. It is only realized when goods are sold. When revenue comes, then this is converted into cash. There's a long time frame between cash to cash conversion. Purchase of raw material, process of raw material into semi-finished goods. Semi-finished goods are converted into finished goods. Finished goods then go to a particular market. They will be provided on credit or cash. If credit, then when they will be sold, then the buyer will transfer back the money. So this cash to cash cycle sometimes is very inconsistent, and therefore finance is required to complete this cash to cash cycle or to continue two to three simultaneous cash to cash cycle. And thus export finance is required. Therefore, this cash to cash cycle assistance is required for procurement, manufacturing, packaging, and logistics. Also, export financing mitigates financial risks associated with long credit periods and delayed payments. Export financing enables competitiveness through extended credit to foreign buyers. Finally, export financing promotes global competitiveness by facilitating large orders and market expansion. Let us now try to highlight the strategic role of export financing in international trade. Export financing strengthens exports liquidity position and finally and financial stability. The liquidity position of exporter means that cash flow should be readily available. Thus, in case an exporter is facing problem with cash, the exporter can take help of export financing to get extra cash. So this is the relevance and importance in international trade. Export financing also enhances ability to undertake large and complex export contracts. The third important role is that export financing helps small and medium enterprises access global markets by lowering entry barriers. The next is export financing improves trust and confidence of foreign buyers through credit based transactions. And finally, export financing supports national trade objectives and foreign exchange earnings. Let us try Let us now try to understand the key features of export finance. Export finance is having a short-term orientation, which means that it typically covers the trade cycle period. Second, export finance is also product specific, that is, it is tied to a specific export contract or order. The third key feature is that export finance is concessional interest rates, that it is given on concessional interest rate, which means export finances are often subsidized to promote exports. The government banks and financial institutions provide subsidized financing to exporters so that they may access new markets as well as in order to make their exports more competitive in the global market. Export finance is also risk linked, which means the risk of export financing is linked to shipment, payment, and political risk. And finally, export finance is related to regulatory oversight, wherein export finance is governed by central bank guidelines and trade policies. Let us now try to understand the financial challenges in export trade. There are different financial challenges in export trade. The first is extended credit terms demanded by foreign buyers. At times, it happens that the foreign buyers require credit terms that are applicable for a longer period. Thus, to facilitate this, exporters require some kind of export financing. Therefore, this is one of the challenge in export financing. The second is production and inventory costs incurred before shipment are quite heavy, and that also puts extra financial burden on the exporters and export trade. The third point relates to the delays in payment realization due to documentation or buyer default. At times, it happened that delays and documentation errors leads to major problems which actually increases the cost of holding the goods. Thus, extra financing is required under such circumstances. The fourth point is currency fluctuation and foreign exchange risk. We all know that in a dynamic global environment, currency fluctuation do happen and which can have more exposure to foreign risk. Thus, it also sometimes requires that exporters be given extra export financing so as to mitigate these losses due to exchange rate. And finally, exporters may incur some kind of additional cost for insurance, certification, logistics, and compliance, for which they may require extra amount of financing and therefore may look towards government financial institutions, bank, etc. to support in order to overcome the exporters from these financial challenges. Let us now try to identify the objectives of export financing. The first objective is to ensure timely availability of funds through the export cycle. The second objective is to support pre-shipment activities such as raw material procurement and production. The third objective is to facilitate post-shipment liquidity while awaiting payment. The fourth objective is to enhance exporters' ability to compete in the global markets. The fifth objective is to reduce reliance on costly short-term borrowings. Let us now try to see that what are the different stages that require finance. The first type of that stage is pre-shipment stage, when the goods have not left the origin country. Financing requirement at that stage is needed for procurement, production, packing, inspection, and shipment preparation. On the other hand, the second stage is shipment stage. Under this, finance is required for freight, insurance, customs clearance, and documentation. The third is post-shipment stage. In this stage, working capital support is required until buyer's payment is received so that production of the goods does not stop. And finally, buyer's credit period is another such requirement where the finance is required to cover deferred payments arrangement that are offered by importers. Dear students, let us now talk about the sources of export finance. In this slide, we are going to have just an overview of what are the different sources. The sources of export finance can be divided into internal sources and external sources. Internal sources are the financing source that are generated through the company or the business itself. For example, self-financing, for example, retained earning of the organization of the company, advance payments received by the company, etc. The benefit with internal sources is that they are cheap and they are useful for the company. External sources includes commercial banks, specialized financial institutions, government agencies, export credit agencies, as well as the international organization. The source of export finance that should be exploited depends on selection. Selection based on size, duration, risk profile, and terms of the export contract. Let us now try to understand the internal sources of export finance in detail. These are the different categories or types of internal sources: own funds, that is retained earning of the company, or reserves of the company may be utilized in short-term financing. The second is advance payment from the buyers. The buyers have given advance payment for purchasing some goods, and that payment lies with the company. So partially the payment may be used or fully the advance payment be used before shipment. The third internal source is internal corporate loans. That is loans which can be taken from other pay companies which are either parent companies or other group entities such as other regional companies. The fourth is supplier credit. At times it happens that supplier gives goods, that is raw materials, on credit. That becomes supplier credit, which can also act as a source of export financing. There is also sources such as commercial bank which can act as a primary source. Commercial banks offer a wide range of pre-shipment and post-shipment finance options for exporters. These banks also provide working capital loans, packing credit, and bills discounting. Not only this, these banks facilitate export documentation handling and foreign exchange transactions. Commercial bank as a primary source extends buyer's credit or supplier's credit arrangement for overseas transactions. Also, commercial banks are often operating under central bank guidelines for concessional financing. The next important issue is the specialized financial institutions that are used in export financing. Export import banks are one of the foundational institutions that can provide financial assistance to the exporters and importers. Generally, the Export Import Bank provides short term, medium term, and long term financing to exporters. These also include the development financial institutions, which support export oriented infrastructure and capital goods. These financial institutions offer refinancing, buyer's credit, lines of credit, and export credit guarantees. Not only this, specialized financial institutions often operate in collaboration with government trade promotion agencies. Dear students, let us now try to focus on government and export promotion schemes. Central banks and government agencies offer concessional finance to promote exports. There are schemes such as interest equalization schemes that reduce cost of export credit. Credit guarantee corporations also provide insurance and credit protection to exporters which facilitate trade. There is availability of subsidized financing for priority sectors, MSMEs, and high value projects. Government and export promotion schemes also support for marketing, participation in trade fairs, and overseas project bidding for the exporters. Dear students, let us now try to focus on international financial institutions. There are several international financial institutions that also provide export financing. The first is World Bank and International Finance Corporation. These organizations support export oriented infrastructure and trade finance projects. The second is Asian Development Bank. This bank provides trade finance programs and risk sharing facilities to the exporters and importers in the Asian region. The third is International Trade Finance Corporations, which offers Sharia compliant financial solutions that are generally applicable for the Middle Eastern countries. The fourth is regional export credit agencies. These are the agencies that facilitates buyers credit and guarantees in cross-border trade. Let us now move to emerging sources of export finance. The emerging sources of export finance includes factoring and forfeiting, which is immediate liquidity through sale of receivables. It also includes financial technology platforms such as digital trade finance solutions and invoice discounting. Use of supply chain finance, where finance is integrated with buyer supplier networks. Export crowdfunding is also an emerging source, which is emerging source for niche products and markets. And finally, blockchain based trade finance, which are secure, fast and transparent financing ecosystem. Let us now try to compare the different financing sources. We have commercial banks, we have specialized export institutions, we have government schemes and international institutions. The commercial banks are widely accessible by the exporters. They have flexible terms and short-term focus. On the other hand, commercial banks may require strong creditworthiness and collateral. Specialized export institutions such as Exim banks provide tailored solutions, export specific products, and medium or long term financial support. The processing times are generally longer and documentation requirements are also there for Exim Bank. The third comparison comes for the government schemes. Government schemes are subsidized interest based scheme, as well as they are focused on certain priority sectors where easier access is facilitated for small and medium enterprises. The problem with government schemes is that they have some limited scope and there are certain eligibility criterias as well. If we talk about institutional international institutions, then there are certain large scale project based financing is also available, and there are also schemes wherein political risk can be covered. Typically, these international institutions financing support is suitable for governments or large corporations. Let us now try to focus on that what are the criterias for selecting a financing source. That a customer that an exporter should focus on what to decide about financing source. The first thing the exporter should look is towards cost of finance. What is the interest rate? What is the fees to be paid to the financial institution? And what is the overall cost structure? The second parameter to be looked is tenure and repayment terms. What is the alignment with export cycle duration? The third thing to be looked is eligibility and documentation. That what is the complexity of the financing and what will be the speed of approval. The fourth is what risk coverage will be there, whether the risk coverage will be political risk, it will be covering all the commercial risk, or it will only be covering the payment risk mitigation. Then currency flexibility, whether borrowing will affect foreign exchange rate, or is there any ability of the exporter to borrow in foreign currency to hedge exchange rate. These questions should be answered in order to identify the source. And finally, ancillary support, which includes advisory services, guarantees and post financing support. Dear students, let us now try to focus on future trends in export financing. Export financing may have different futuristic trends based on changing dynamic environment as well as the rapid change in technology. The first future trend to look for is the increasing role of credit insurance and guarantee mechanisms. Under credit insurance, we know that now it is mandatory for maritime or for exporting goods to be insured. There can be general insurance or specific situation insurance. Thus, the more use of insurance in such type of activities is a future trend. The second future trend to look for in export financing is the greater collaboration between banks, financial technology institutions, and export agencies. There was a time when export agencies were standalone agencies, but now export financing has become a triangle of banks, fintech means financial technology institutions, and the export agencies. So, this blend of these three are making things easier, and more different types of products are emerging, which is beneficial in terms of export financing for the exporters as well as for the international trade. The third futuristic trend is integration of ESG into the financing criteria. ESG stands for environmental parameter, social parameter, and governance parameter. These parameters tell us whether financing will be sustainable or not. As we all have a target of creating sustainable economy and we have targets of achieving sustainable development goals, it is important to inculcate ESG integration into export financing. The fourth futuristic trend is growth of structured trade finance and supply chain finance solution. And finally, it is enhanced focused on financing for services and digital exports. Dear students, now it is time for us to conclude what all we have discussed. In today's lecture, we have highlighted that export finance is critical enabler of global trade competitiveness. We have also identified that export finance addresses liquidity challenges, it mitigates risk and supports business expansion. Export finance can have diverse range of sources such as internal, external, institutional and international, and these sources cater to varied exporter needs. Also, the strategic use of export finance enhances competitiveness, ensures smooth operations, and fosters sustainable growth. Thus, in a nutshell, mastery of financing fundamentals is essential before exploring advanced instruments and mechanisms in export finance. Dear students, thank you very much for being with me in this session.